Which way is the market moving? And what should I use to analyze that market? Should I use the futures markets? Should I use the equities market? Should I use the index markets? And so today we're going to take a look at the S&P 500 from all three and see what is the best one to analyze and then what might be the best one to trade on today's Market Brief. Good morning, everybody. Hope you're all having a great day. As we analyze the market, sometimes we're going to use indexes, sometimes we're going to use ETFs, and sometimes we're going to use futures, and we're going to trade each one for different purposes and different reasons. And so what I want to do today is just kind of analyze the difference between them. And I started this because, I spend most of my time analyzing futures, but in reality, I look at the percentage of people that actually trade futures, and it's a much, much smaller percentage. And so when I'm looking for swing trading or longer term investing ideas, I'm going to look for probably a different thing that I would be identifying for tradable opportunities than the futures market. So if you're new to the channel, by the way, click the subscribe button, hit the notification bell so you get the alerts and the updates every time that we post new content here on the Market Brief. I want to take a look and talk today about the differences between the three. So the first would be an index, right? An index itself is not tradable. The index itself is not tradable, so I can't really trade the S&P index. I have to trade a derivative of the index, and oftentimes that means I'm going to trade the option. So I can trade the option on the index. Number two would be the ETF, Exchange Traded Fund. And for those of you unfamiliar with Exchange Traded Funds, they're stocks that essentially give me the performance of the index, which are also going to be optionable, but not always going to be the best avenue depending on what it is you're trading, which ETF you're using. And then the third would be the futures market. And futures bring their own set of unique opportunities to them. So let's go ahead and take a look at the charts and compare and contrast the three. So what you can see right here is that the chart we're looking at is a chart of the SPX. And this chart of the SPX, this is the actual index. What I'm going to do now is switch it over to the SPY. And when I switch over to the SPY, you notice a minimal change, right? A minimal change. This is the S&P 500 ETF, Exchange Traded Fund. And then I switch over to the ES, which is the futures market. And what you'll notice is almost no change between those three. Some subtle differences, however, right? So, for example, my index is sitting at 43.73. If I look at the SPX, it's sitting at 43.73. When I move to the SPY, it is trading at 436.04. And then when I look at the ES, I see 4388.5. So why all the different numbers? Well, all the different numbers because they're not all the same thing. They represent the same thing, but they are not all the same thing. The ES represents the price of the S&P's expectation in the future on expiration. And in this case, that expiration would be in December. So in December, the futures market essentially saying is that we believe it'll trade at 43.89. That's where you're saying it's going to finish up on that date. If you buy this S&P futures market, you are generally saying that I'm a believer that the market's going to be above 43.89 at expiration. If I sell this S&P futures market, you're saying it's going to be below 43.90 at expiration. Futures are primarily used as hedging vehicles against other positions that somebody may have. So the fact that they are hedging vehicles against other positions that somebody may have are very important. We want to look at futures as primarily short-term trading opportunities. Day trading, maybe some swing trading, but I primarily don't really think it makes for a great idea to hold futures over a weekend because then I don't have my stop losses in place. So what are the real differences? Well, the real differences are going to come primarily when we look at intraday trading. So let's go to, say, a 15-minute chart. And I'm right now looking at the ES on a 15-minute chart, whereas each candlestick represents 15 minutes. What I'm going to do is I'm going to put two charts next to one another and make them look somewhat the same. So here's two 15-minute charts of the ES. zoom in so that we're looking at roughly apples to apples comparisons. So now they're fairly close to the same stock, but I'm going to move this over from the ES to the SPY. And what will we notice when I switch it over to the SPY? Well, a couple of things. First of all, the most obvious is that the SPY shows me areas where there's no trading. These are known as gaps. So these gaps exist in the SPY. Secondarily, the SPY, if I just look at yesterday's price action, only goes from market open at 8:30 Central until market close at 3 o'clock Central. So 8:30 to 3 Central, 9:30 to 4 Eastern time. And then there's no trading before 8:30. Now, what I can do is I can look at pre and post market trading of these equity markets, right? So if I want to look at the pre and the post market trading of these equities, I can turn it on to show extended hours. And now I see the pre and post market trading highlighted here in the gray. Why does that matter? Well, if I just zoom in on yesterday's price action, I will see essentially now a very similar look and feel to what we're seeing in the futures market. So I could theoretically trade in the pre and post market of the SPY in order to mimic the performance of what I would get in the futures markets. This does not have quite the same liquidity that the futures market would have. And I would recommend that if you want to do pre and post market trading, you're probably going to be better off just simply trading the futures markets from a liquidity standpoint. So when I'm looking at intraday trading opportunities, I primarily think the futures are going to be a better way to go because I've got better liquidity in the overnight hours. The other reason is that I can use a lot less capital to trade it, whereas this SPY, I'm going to have to put up a marginable amount, maybe 2-to-1 overnight margin on these SPY, so roughly $232 per share if I do the 2-to-1 overnight margin. The ES I can do usually with significantly lower margins, but I'm going to control a lot more. And so you can go to the website, TradersArmy.com, and there's an additional course on why futures. If you're interested in learning more, I can put the link in the description below. But looking at the S&P, I think from an intraday basis, the ES is going to be the better one to trade. Well, what about the SPX, right? What about the actual index that is the SPX? Well, the SPX doesn't give me as many windows for post-market trading. I don't have as large of a pre- and post-market opportunity in the SPX. And the difference is with the SPX, it is not something that I can just go out and trade. I can't just buy the SPX because it's not a stock. There's no ownership to be had there. So if I'm trading the SPX versus the ES or the SPY, the SPX is primarily going to be used only to trade options, right? I would want to be optionable on the SPX. That would be the advantage of the SPX. Now, why would I want to trade the SPX? What are the advantages of trading the SPX over the SPY when looking at some of these different opportunities? Well, the SPX from an options perspective, if I look at the SPY and I go to my options, in my S&P 500, I essentially have options that expire every day. Just about every day I have options that expire, which means that if I want to say, well, I want to buy an option that if I get paid if it goes above here, then I would certainly maybe just buy a one-day call option to trade for the breakout. But I could also do an option that says, I want to get paid assuming it's going to stay in this range for tomorrow, right? So 440 by 430, right? Maybe I'm pretty sure that it's going to stay in that range. Well, in that case, I might give myself a 2-day window on those 440 by 430 options, and you can see that I have basically every strike price available. So the 440s by 430s are available. I could do the 430 by 425 and then the 440 by 445 bear call and bull put, do some sort of an iron condor in order to spread my risk out in a much wider area. And whether I do the SPY, I could also do the same thing because I've got, once again, daily expirations essentially. I can do the same thing with the SPX. All right? So I can essentially do the same thing with the SPX options, which allows me much more flexibility. Now, why would I do these? The reason you would do these is because you are looking to capitalize on minimal movement and you're selling options that expire in a very short window of time. So what that means is that if I'm looking to capitalize on market movement for as a day trader, I'm probably going to trade the futures markets because I need the movement. If I want to capitalize as a short-term trader on minimal movement, I will use options on the index or the ETF. Now, what about a long-term investor? Well, as a long-term investor, to analyze, I just use the SPX. If I'm analyzing this market as a longer-term investor, I primarily use the SPX because it is the actual index that everything else is based off of. We've already spoken about, if you've watched the show in the last few weeks, the 8 and 20 exponential moving average system on the weekly chart is one of my preferred ways to analyze where the market could be going. And you can see that we just popped above the 8 yesterday on that weekly moving average. I've not closed above it yet, but I've popped above that 8-period weekly moving average. But we're still in the context of a bigger picture downward trend with lower swing lows and lower swing highs. So for longer term investing, SPX for analyzation. For short-term directional trading, ES futures markets. For short-term non-directional trading, SPY or SPX options, I think, are the better way to go. If you have any questions, as always, send us an email, support@tradersarmy.com. Hope you guys have a great day, and I will talk to you later this week. See ya.